Trading Plan Saturdays. This is CR investor Brian Beamish coming to you. Let's make sure we have everything up and running here. We got to have a nice Google screen for you here. Let's see. You can see my beautiful mug right now, but we'd rather take a look at the website. Great to see. Let's see what we're doing here. Yeah, great to see that we got everything up and running and everything's great. So, we might as well start right off the bat. It's been suggested to me that the previous format that I was running for these shows was just a little bit too long. And the best bet, whoops, what happened to the website? Let's make sure that it's loading. The best thing to do if I was thinking about continuing these things over time was to try and bring the duration of these down. So we're going to try and limit this show to about a half an hour. Really, at this point, I'm feeling as though with that kind of time constraint, we'll probably just have enough time to go through some of the material that I'm looking at. Maybe talk a little bit about anything in particular that's jumping out at me. And maybe open the floor up to questions and answers should the viewership warrant it. These shows, as always, are streamed two ways, and I'll put the Google Hangout link in the YouTube page. Let's go ahead and see if we can change that now while I'm on the fly here. This should be interesting. Google Hangout ADR, we'll just put that in there. So there that is. Looks like that should work. Let's see if they take that. Don't know why it's saying go live now. I wonder if that changed it. So, wow, this is interesting. We're zipping all over the place here. Hopefully we're still live. Let's see what happened. Live events, there we are. And yeah, it sounds like we're just marching away here. So this would be a fun experiment to see how these Google Hangouts work. But anyway, I went and tried to add the address. Did it work? Oh, it did. Look at that. So if you are watching and you would like to pop into the lounge, if you have a question or anything, feel free. We'll just take it one step at a time. I am running this on my own right now, so by all means, if you'd like to join me, you're more than welcome. If you have a question, I'm going to have to pop over to the YouTube. In fact, maybe we get rid of that Google page now. Just pop over to the YouTube page and put a question in the comments. I'll sort of keep an eye on this, make sure that it's running smoothly. And it's good to see that everything seems to be operating. All right, so these Saturday shows, I had sort of my original intention. Keep in mind, you can read about my background on the website or, a nice little PDF that I have here that a lot of people seem to download. I come at this from a financial planning perspective. I was a full-service broker for a number of years. And so I really like the idea of taking one day a week and just talking about things like trading plans, trading psychology, how do you mentally feel, all those kind of things. As students of the market, of course, we are constantly learning, constantly evolving, trying new things. Our trading plan, of course, itself is a living document. It constantly changes with our experience in the market. We try one system, we try another. That's perfectly fine, just as long as you try and stick with that trading plan. Again, sort of keeping the idea that we want to keep this to a half an hour. What I'm probably going to do at this point is maybe talk a little bit about some of the recent additions that I've made to the site and information that you can take advantage of at your leisure. maybe have like sort of one theme of the week. We'll concentrate on one section of my sort of trading plan and trading risk part of my course. And then, as I said, typically, as these shows go on, we get sort of more following. I might have the floor open for a question and answer. And I fully understand that for the first few of these shows, the viewership will probably be pretty limited. So I guess what we can start with is I've been busy adding content to the YouTube page to help you better understand the materials that I've been producing. So, you can always pop up the YouTube page just from clicking on any one of these YouTube links. Basically, the past few days I've spent some time creating a tour, video tour of the site. So if you want to learn more about what's available on the site, it's about a half an hour long. And it just goes into depth into all the different services that are available, free and otherwise. As well, I have been working away on a tutorial specifically on how to, I guess, a video walkthrough of the lengthy course that I wrote recently on building trading plans. And you can always find that just by going to the website, therationalinvestor.ca, clicking on seminars. And it's this first link, Take CRI's Introduction to How Capital Markets Work and Building an Investment Plan. And there is the document right there, and this is probably what I'm going to refer to a lot through these Saturday shows. So this tutorial that I've worked on here and specifically is basically a video walkthrough of this course. So they do go hand in hand very well. So if you are considering taking your learning of the market to the next step, I highly encourage you to watch the video while you're looking at the document, and then that way the two go sort of hand in hand. The plans going forward will be to make video modules of each of these sections. As the outline part points out, there's 4 different parts to this course, and each one of them is easily a video unto itself. But that's coming in the future. I just wanted to sort of give you a heads up of what's available now for you. So that's basically the summary of what content I've added recently, and as I said before, you can find that on the YouTube sites pretty easily. As for the stock market itself, my recent posts, I think, about the S&P 500 are, in my mind, I think they're still perfectly valid. Having said that, obviously the market's moving higher here, but and is this diamond pattern going to play itself out? Obviously, the diamond's being broken here to the upside, but seasonally speaking, this is a very dangerous time of year. So I am looking for some sort of seasonal top to come in here. If we're lucky, we can get through this period unscathed, but if we start to actually look at price action from a broader perspective, let's see if this chart will load up for us. I don't think it will. Let's see, S&P 500. Let's look at this one. So if we look at the S&Ps, which is our sort of proxy for the stock market in general, and this has been sort of the message I've been trying to convey to people, is, even if we just look at it, you do see this, and I had pointed it out on a previous post, that this is what's called a megaphone pattern when the trend lines are expanding like this, which means there's going to be a lot of volatility. These are really, really tough markets to trade. It's not a nice, simple, easy breakout, unfortunately, and it is a rising trend line, so really we can't make the argument that the trend is down until we start to see lower highs and lower lows, which we just simply don't have yet. So our old all-time high here, 190.42, is being tested. 190.48 was our recent high, so there's another new high. Is the pullback happening today? It doesn't look like it. Looks like we're still heading up, but at the same time, this solid blue line looks to me to be fairly significant resistance, so we'll see how we act up in that area. That's sort of broader market comment. I suppose we ought to. It wouldn't be a cyber show unless we had at least a comment on the old Bitcoin. We had this nice trade set up here recently, nice inverted head and shoulders, and you can see that the market did zoom up and actually surpass the upside target. We seem to be getting a little nosebleedy up here. We'll see how this plays out. I have updated this trade setup here as of this morning, so you can get sort of my current thoughts as to what I think is happening with the Bitcoin. But I think probably more importantly for Saturdays, we should really concentrate on how the Bitcoin sort of fits in the broader scheme of things. So, like if we just look at just simple trading trading plan ideas and sort of asset management, I think it's a good idea that we always just refer back to good old CRI's 2 rules of investing. So, number one is come up with your algorithmic approach to your investment decisions. And long and short of that is, there are lots of relatively consistent price patterns that you can use, couple them with some momentum and volume indicators, and you can have a pretty reliable system that meets this 66% accuracy. Rule number 2 is really what we're most concerned about today, and that is don't risk more than 5% of your stake on any one single investment idea. And the bottom line to that is if you were to take a substantial risk and the trade goes against you, how are you going to react when that happens? And unfortunately, people don't really like to think of their investment attempts in failure terms, but I would argue that it's probably a good idea to always approach this from a risk-first perspective. So, what am I willing to risk? What is it that is going to represent if this idea fails? And can I come back tomorrow and play the game again? So that's the whole purpose behind that rule, and really that's the focus of today's show. Maybe what we'll do for today is why don't we just talk a little bit about how you handle this rule number 2. Because there are a number of different ways that you can handle this risk number. So let's zip on down to that part of the course. It's a fairly lengthy document, and as I've said before, this document just sits on the internet. You can see there's somebody online right now looking at the document, and it's interesting because I pointed out in my intro to this course video that I did today that it seems like almost every time I come onto this document somebody's here. So obviously people are getting good use out of it. All right, so we're talking about trading plans, we're talking about risk, so that's all part of part 4 of this course, getting personal. And really, my feeling is that part 1, 2, and 3 are all about rule number 1, and part 4 is all about rule number 2. Unfortunately, this is the part of investing people don't really like to talk about, and that is, well, if I'm wrong, what's going to happen? How bad is bad going to be? And so, that's what all this talks about. So I thought what we do here is, let's see which part it is here. I think it's section number 3, incorporating a risk-first approach to our investing. All right, so this is page 7 of 15 of the Getting Personal, and really what I want to talk about today is rule number 2, specifically about risk, and then what are the different ways that we can take that risk. So rule number 2, and we'll just read from the course because, hey, I wrote it. Obviously, I like the words that I wrote. So I said, after all you've read before, it really brings us to one ultimate question, and that question is, how much of your portfolio is worth risking on any one bet? Interestingly here, we need to actually go to a completely different venue to actually understand that question. It turns out that there's those in our society that literally bet for a living. There are professional tours that gamblers follow in the hopes of making a career from playing poker, for example. And some make very good careers of it. In fact, probably over the past 10, 15 years, we've watched these television shows that highlight the professional poker tour. And frankly, I'm very impressed with both the way these players handle themselves when they lose, but really what's interesting is how they actually handle themselves almost exactly the same way when they win. So it's not like they go bananas when they hit the jackpot. Ironically enough, their emotional response is almost exactly the same as if they lose. So try and that's that. You can take a lot of wisdom away from the way they handle themselves. So these professionals work very hard at their craft, no doubt about it. I mean, this is hard work. They often show little emotion, win or lose, and are very good at interpreting statistical data. And really that's what, proper investing is all about. And once we've gotten to this point of the course, that's rule number 1. A system has to be at least 2/3 accurate, right? And that's all this sort of statistics. One of their main talents is to always be able to fight another day. In essence, no one bet ever takes you to the point where you simply cannot come back and play again. This simple rule is very transferable to the investing world. While the exact percentage of your stake is debatable, and there's some people that actually, like if you talk to a lot of Forex guys, they don't even like to risk more than, say, 2 to 3%. But as a broker, what I seem to find, and this is sort of where it mirrors the gambling community, is there's a general consensus on one specific level, and that is this 5%. And really, like I said, taken straight from the poker tables. Well, that by definition limits our gains, right? Because there's only so much money you can throw at any one bet if you want to meet those 5% criteria. It also ensures that you'll always be able to come back and play again. So hopefully you're hearing the same message over and over and over. If we look at this model from a statistical perspective, the rule makes a lot more sense. So to be successful at investing, one needs an edge, right? And that's our rule number 1. If your system or edge is indeed greater than 50% accurate, then the 5% rule allows for 20 individual inputs into a statistical model. While a handful of inputs may be skewed, subject to short-term anomalies, 20 inputs seems to be the accepted minimum level for a statistical model to be given a chance at working. So what am I trying to say with all that? I mean, the long and short of it here is that as traders, we will have losing streaks. I mean, it's just the way life seems to work. And if you're only going to bet, like, say, 3 or 4 times, then how do you have enough faith in the statistical model that either A, you are not going through a hot winning streak and you're overestimating your performance, or B, you're going through a losing streak and your statistical performance obviously is skewed to negative performance. It's only by having enough, you have to sort of hit that critical mass number in a statistical model for you to actually see those statistics over the long run. If you, like I said, if you had if you did 3 bets and you said, okay, I'm going to run my model off of that, and I'm going to bet, I think my model is at least 50% accurate, but let's say you go through a losing streak and the first 3 trades are losers and the 4th is a winner. If you follow proper risk management strategies, you can actually come out scratch on the trade if you have a minimum of 3-to-1 risk reward. But at the same time, you look at your statistical model and you say, gee whiz, I was only right one time out of 4. Does that mean that I only have 25% accuracy? What happens if, the next 4 inputs happen to go 3 winners and 1 loser? Now, there's no way of you knowing what those next inputs were if you only limit yourself to 4 attempts. So long and short of all this is 20 attempts seems to be the accepted norm, and what a coincidence that just seems to fall in that 5% category. So the two seem to work hand in hand quite nicely. Now, 5%, and this is sort of the big value of, I think, what we're going to want to try and focus on today. 5% can come in many different forms, all right? Never risk more than 5%, yes, but that 5% can come in many different ways. So, yes, we are going to adhere to that 5% rule. And we understand statistical anomalies might prevent us from seeing our accuracy if we have too few inputs. What are the various ways of implementing this 5% rule, right? So, we're just going to briefly take a look at 4 different ways you can obey that 5% rule and yet have very, very different outcomes. So, first and foremost, obviously, and really, what this is basically it's a function of risk and reward. Obviously, the less amount of risk you're going to take, the less amount of reward you're going to have. And conversely, the higher amount of risk you're going to take is going to equate to a higher amount of reward. So, starting off with the least risky but least rewardy is we could literally just risk 5% of our stake, and that will risk that 100% amount. So let's say we're working with $10,000. We're going to put $500 into work into something, and we're just going to risk that entire $500. The interesting thing about this, of course, is that, obviously the products that we're going to participate in are going to be limited. We're not going to be thinking about options. We're not going to be thinking about futures. We could be long stock. We could be long bonds if we can find someone to sell us a $500 bond. We could be long indexes or long mutual funds. Nice and simple. Just buy it and own it. And the irony of it all is that if you had bought $500 of Microsoft way back when, that had basically unlimited earnings potential, right? I mean, you're not going to make as much as if you were heavily leveraged on that $500, but your earnings potential are unlimited. So that's sort of our least risky, and really, if I was talking to mom and pop and doing retirement planning, this is probably the route I'd like for people to go. Just simply figure out what 5% of your stake or whatever it is you're going to risk in the market, and then put that to work into a product and just say, you know what, I've done my research. I know I'm right 2/3 of the time. I'm going to risk this $500 on it and let it go. All right, moving up sort of the risk ladder and obviously the reward ladder is we could risk 10% of our stake, or twice the amount of our scenario number 1, but we're only going to risk 50% of that. So basically, if the asset falls in half from whatever we bought it at, whatever level we bought it at, then we're going to get out and basically admit defeat. That is sometimes a very hard thing for people to do, because basically admitting defeat is ending the dream, right? So if you bought yourself into a nice little growth stock and you figured it's going to be the next Microsoft or Apple or whatever, if it does go down 50%, you have to respect that rule and get out. And so that's kind of why I like the mom and pop strategy of number 1. In that if they've done their homework and they believe in their system, then basically they're not going to sell, they're just going to risk that capital. Scenario number 2 says, well, you know what, there is an uncle point at some point, and if we hit that uncle point, then we got to get out. Now, having said that, obviously, as you can see from this model, your reward is going to be twice as much as scenario number 1. So obviously, a little bit more risk, and obviously you're going to get a bit more reward. Moving down the food chain here, trading on margin. All right, so this is a little bit higher risk, obviously, because basically what you're doing is you're borrowing the asset and only putting a fraction of the principal value down. And if you were looking at futures contracts, you're not even putting any of the value of the asset down. You're putting up what they call a performance bond, which just basically says, this is money collateral that I'm going to risk, to control this contract. So long and short of it here is, again, you could take 5% of your stake and risk it on margin on a stock or a futures contract or forex or something along those lines. But you are subject, of course, to margin calls. So obviously, if the position moves against you by 5% of your portfolio's value, then you have to walk away. And that might, like if it's like a crude oil contract or something, and you have a $10,000 portfolio, well, that's $500, and in crude oil, that's 50 cents. So, obviously, again, we're moving up the food chain here. We're taking much, much more risk here now. Basically, we're putting up a performance bond. That's this margin principle, and we have a very finite risk depending on just the supreme leverage of the product. The basic message here is that's perfectly fine, but you have to respect the fact that if you breach that 5% level of your portfolio, you got to get out. Just as simple as that. And that, again, is a very hard pill for new investors, traders to follow. And really, once we start talking about trading on margin and trading derivatives, we're definitely talking about more advanced strategies. And then the last, of course, which is, of course, the most risk and obviously the most reward, is trading the derivatives market, and that's basically trading options on products. So that's why we've highlighted options. So you can buy an option on a stock, you can buy an option on a futures, you can buy an option on a bond, on mutual funds. Well, not so much on funds, but definitely on forex. And most any listed product has options because basically options are insurance policies. So there's a lot of institutions that just use options purely for insurance. Long and short of this here is we're going to risk 5% of less than 5% of our stake. So, let's say we buy an options contract, again, using our $10,000 portfolio. And if you wanted to buy an at-the-money option, usually they're a couple $1,000s. So, maybe you have to buy an out-of-the-money option, of which you're going to risk 50% of the purchase price of the option, and that risk has to be less than 5% of your portfolio. Now, obviously, with options, there's absolutely unlimited earnings potential, but at the same time, there is an expiry. So unlike just buying the stock, nice and conservative mom and pop, or even buying the stock on margin, the options have a specific risk in that they basically will disappear over time. And so that carries a whole bunch of risk with it too. But having said that, the purpose of today's tutorial and what I wanted to speak to you guys today about was just a simple notion that rule number 2 says don't risk more than 5% of your stake on any one single investment idea. And there are a number of different ways to handle that 5% rule. And the conversations that I've been having with professional traders, I noticed that they basically follow this 5% rule. In fact, they probably even risk less than that. But as a broker, I've personally found that this 5% rule is pretty much the threshold to keep yourself out of trouble. Okay, so I would encourage you to review this material. Again, you can get this document on the website, and we can always put it down on. Well, I've probably posted it plenty, but you can find this document off of the website, my website here, just by clicking on Take CRI's Introduction to How Capital Markets Work. And this is section 4, Getting Personal, and we're talking specifically about, where are we here? Section 3, incorporating a risk-first approach to your trading ideas. So you can find that there. So basically, that's about a half an hour. So these things go by very, very quickly. Just a quick sort of pop in, pop out to say hello and let everybody know that these shows are continuing. If you have any questions, feel free in the future to either be a part of the trading forum, and that's this Google Hangouts address. You can always pop in and ask a question in person. Or if you'd like, you can pop in and ask a question on the YouTube page. So since obviously there aren't a lot of participants today because there wasn't a lot of notice that we were going to be doing this show, I think I'll probably leave it at that for now. But have yourselves a great trading day, and be sure to check out all the new YouTube videos that I have up on offer on the channel. Let's see if we can pull up that channel. How do you do that? Something like this, my channel. Here we go. Let's see what we got now. All right, so lots of new stuff for you guys to chew on, and these shows will continue on. The show must go on, as they say. And feel free to pop by the website. And my little plug here, as always. And I see you guys are doing just a phenomenal job helping me out. But if you do see some value in the information that you've been given here, you can sort of reciprocate by popping over to the donate button on the front page of therationalinvestor.ca and make a small donation to help me keep this program moving. So have a great week, all. We'll be back, I guess, Monday to talk options and. DB for the questions and stuff. So any of these sites, you can get a hold of me as well, ask questions, and usually I'm around the TradingView community as well, so you can get a hold of me there as well. So have yourselves a great day. All the best. This has been CR Investor Brian Beamish with our trading plan Saturdays review of risk and how we should properly handle it. That's that 5% rule. So you guys have a great week and all the best, and look next week for another offering on trading plans. All right, guys, have a great week and all the best.